We're certainly thankful for this opportunity to gather together with each of you today and look at these numbers from KFMA farms from last year and the years before. It's kind of interesting as we look at the fact of maintaining of this KFMA database, and we now have 50 years worth of history to look at as we consider numbers here, and we will look at some of those long-term numbers as well today. But as we begin, and certainly do want to invite any of you as you have questions. I think Rich will help us make sure and notice the questions as they come in the chat. I am Kevin Herbel, work as Executive Director of the KFMA program. Mark Dikeman, Associate Director, will be moving back and forth between one another as we go through the slides here on the KFMA summary. But as we begin, want to certainly express thankfulness to the KFMA members that are participants in the KFMA program. We're very thankful for the opportunity, all of us, Mark and I, those who work as economists, as support staff in the KFMA program, are very thankful for the opportunity to serve those individual farm managers and their families. Our work within KFMA is very much focused first on serving and seeking to meet the needs as we can of those families. As a result, we have summary reports such as this, ability to assess the impact of various events, various times on the agriculture sector. Certainly our membership is not intended to be a direct representation of all farms in Kansas, but does allow, as we look from year to year at assessing the impact of things that have occurred in each of those years on the agriculture sector here in Kansas. And also as a result of that, there's the availability of a data bank for research in the Ag Econ department. So we don't mention it, at least I don't think we do frequently enough, just thankfulness to those who are KFMA members and the appreciation we have for your participation with us in the ability to work for the benefit of the agriculture industry. All right, Mark. The 2020 results, net farm income, and many of you may have seen this already as we've had some radio interviews and some media releases and such, but the 2020 net income at 167,894 was up quite a bit from where the level had been in 2019. As we look at the year of 2020, certainly a year of much uncertainty, much volatility, and during the last 12 months, much has changed. When projections were done a year ago relative to what was 2020 going to look like, we were looking at as much as an 80 to 90% decrease in net farm income due to those impacts of COVID, impacts of the various disruptions that occurred because of that. In the end, 2020, we did see fairly good yields in many parts of the state. The price improvements at the end of the year and those grain inventory values, their impact on the income, all of that working to benefit things. And just before we move on from that discussion of prices, something that we'll maybe mention several times just to put it in your ear a few times over here. But while our prices for grains have come down from the highs, certainly each of you who have grains to sell, don't overlook opportunities to price at levels that are above your cost of production. And I think that's worthy of reminder relative to where our prices are from where they have been and where we will be looking at again in the future. So 2020 did bring challenges for livestock producers, particularly those in the livestock feeding area. If we consider this income, the 168,000 here is the average of all of the farms in the summary. Each year we do divide those in net income quartiles, and there's quite a variation from one to the next. The top quartile was showing just under 467,000 net farm income for 2020. The bottom quartile recorded a net loss of 24,615. So very important for each farm to have their own records and know and understand their own position. Within those records, about 12.5%. And here, if you look at this chart, is just looking at the distribution of income for both 2019 and 2020. Looking across there at the left, those two sets of bars furthest left, farms that were showing a loss, 12.5% of those in 2020 were showing a loss. That had been 18% in 2019. If we went back to the year where our income dropped quite substantially in 2015, there were actually 44% of the farms with a net income that was negative at that time. Certainly the stress, the difficulty for a given operation increases as there are multiple years of negative net income that are put together. The percent with 3 years or more of consecutive negative income has dropped this year. It was about 7% several years ago in 2018. In 2020, about 3.5% of the farms have 3 or more years consecutive of negative net farm income. And so the number of farms with the stress of that level has decreased. But these farms with a negative income plus those with positive income, that third set of bars there going up to 50,000, each of those farms would not have sufficient income for many cases to cover family living expenses. Nearly a third, it's 31.85% in 2020, were 50,000 positive income or less, including those with negative. And those operations are very likely either using up equity as they go through that year, or require a source of income from off the farm to help provide for those that farm is seeking to meet the needs of. That number, if we look back at 2019, compared to the 32% this year, was 42% in 2019. And I referenced 2015 earlier. In that year, it was 69% of the farms in the KFMA summary. Mentioned just briefly there, not having sufficient dollars to cover family living. Here's a chart just looking since 2020, so 21 years, I guess, worth of family living expense. The line going across represents the net farm income for KFMA farms in each of those years. The purple part of the bar, the family living expenses, the gray part representing income taxes paid in each of those years. And in 2020, average family living expense was just under 72,000, which is down about 2,000 from the level it was in 2019, but very similar to the 2018 level. Income and self-employment tax paid was just over 19,000 for the 2020 year. And with those two together, the total family living expense plus taxes in 2020 was $91,007. So can see how different years there, net income under the amount needed, other years that are over, and certainly adjustments made as time goes. But the living expense been fairly level for the last 4 or 5 years.
Let's take a look at the average net farm income for each of the 6 associations across the state. In all 6 associations, net income was higher in 2020 compared to 2019. Our highest association was the Southwest at 233,000, and the South Central Association at 195. That was a fairly significant change for that association compared to 2019. Kevin mentioned the impact of yields in different locations across the state, and we can certainly see that in the net farm income numbers. In the North Central, Northeast, and South Central associations, yields were decent, especially when it comes to the fall crops. In the Southwest Association and well, in the extreme western part of the state, yields were down and had an impact on the net farm income in those associations. We can kind of see that by looking at the net crop insurance paid or received, where we look at indemnity payments minus premiums paid. For 3 associations, the 3 with the North Central, South Central, and Northeast that I mentioned were strong in fall crop yields. The premiums paid were actually higher than payments received. So indicating that that more was paid out than received in crop insurance indemnity payments. For the Southwest Association, kind of a tale of two cities there. In the western part of that association, yields were down considerably, and but in the eastern half of that association, yields were fairly strong. So overall, when we look at premium or indemnity payments received minus premiums paid, it was about even for the association. In the Northwest Association, a different story. Indemnity payments received over premiums paid was about $27,000. So a significant amount of crop insurance received there. And similar in the Southeast Association, that difference was a positive $10,700. And we should note that Kevin mentioned the high prices towards the end of the year, that high grain prices don't help you much if you don't have the bushels to sell. So, and I think that's reflected in a couple of the associations. Before we talk too much about the highs and lows of 2020, the wild ride that was 2020, we do think it's important to acknowledge that that a lot of people have experienced some significant difficulty during the year. We may talk about averages and positives or negatives for the year, but it's really important to consider that some people did have considerable losses, significant losses that they may still be dealing with, whether that's loss of loved ones or loss of employment or something similar. I think maybe one way to describe 2020 is somewhat of a roller coaster. Ups and downs, twists and turns, I think affected everybody. And those sorts of things can take a toll on someone both physically and mentally. So I think it's important to acknowledge that. We all know of disruptions in markets and supply chains, shortage of toilet paper, empty shelves at the grocery store, businesses shuttered, illnesses, loss of loved ones, time not spent together, and those sorts of uncertainties all take a toll on us in our personal lives and the economy. As a response to the uncertainty and to the pandemic, several pieces of legislation were released that helped to address this or helped lessen the impact. We saw 2 rounds of the Coronavirus Food Assistance Program, CFAP 1 and 2, Paycheck Protection loans or Paycheck Protection Program loans in 20 and into 22 or 21, I'm sorry. And then economic injury disaster loans to an extent were a part of what helped many get through the year. As we mentioned, there were some areas where yields were very strong and areas where yields were not as not quite up to or didn't meet average. When we, as in any year, when grain prices are strong, that often puts a squeeze on livestock producers. That I think is still being felt for those livestock producers. Now, one I guess benefit of for at least for grain producers, that those strong grain prices at the end of the year for those who had the inventory to sell put them in a very good, very strong position from a working capital standpoint. and the profitability of farms allowed some debt to be paid down and put producers in a better position from a debt standpoint. One thing that was a little surprising, I think, to both Kevin and I, is the increase in machinery investment on a per crop acre basis. That increased by 16% in 2020. I suspect that some of that is a response to some of the government program payments that came towards the end of the year, CFAP 2 in particular. I guess we should note that although PPP loans were somewhat significant influence in profitability of farms, I think that influence will be felt to a greater extent in 2021 as legislation late in the year kind of changed the rules and allowed more producers to qualify for those loans and created a second round of PPP loans. In addition to that, we'll see some CFAP 3 payments in 2021, and we'll see how those influence the profitability for the year.
All right, and as Mark's discussed there, some of the COVID-related legislation, we'll move next into looking what really was that impact on our net incomes during 2020. And as we say COVID-related government payments, what we will be referencing would be CFAP 1 and CFAP 2 that Mark referenced, would be any idle grants received by the KFMA member farm, and PPP loan forgiveness received, about 22%. Mark mentioned that we would expect more of that to maybe show up in 2021, and for 2020, about 22% of the KFMA farms had forgiveness received during the year. The average forgiveness for those farms was a little over $23,000 per farm, but we do expect to see more of that occurring in the coming year. So those are the items that we're talking about as we speak to the COVID-related payments. The level of those at the state level, you can see there, the slide shows 45% of our net farm income. The dollar amount was $75,770 per farm. Around the regions, the high for the COVID-related payments, both in percent and dollar amount, was Northwest Kansas, where it was 87% of their net income, just over $114,500 per farm. And the low was in South Central Kansas, $44,228 per farm, about 23% of that net farm income for the year. As we consider these government payments, certainly looking forward to, or as we move forward here in the slides, looking at all government payments received. So our number, as we say, total government program payments, that's going to include those COVID-related dollars that we just referenced. Added to that would be our traditional program payments, the ARC and PLC payments received by the farms, those amounts that were received in 2020. Any livestock forage program or livestock indemnity program payments received, the dairy margin program. 2020 did see some WIP plus payments that were fairly substantial, particularly in some areas of the state. 40% of the KFMA farms received WIP plus payments, and those amounts were highest in North Central and Southeast Kansas, thinking back to some of the influences on crop yields and some of the prevent plant and those type of things in 2018 and 2019. And then also conservation payments would be included in that total government payments. So EQIP payments, CRP, state-related payments. In total, 67% of our net farm income at the state level, just over $113,000 per farm. The highest here, again, was Northwest Kansas with $173,557 in total dollars. It was 132% of the net income. And South Central, again, the low, $84,800, or about 43% of their net income. The dollar amounts in In Northeast, very similar to South Central, just above 80,000. North Central was at 107,800, and Southeast 119,785. Southwest a little over 134,000 coming from total government programs. If we looked at or consider kind of here, what would our incomes look like if we took those government programs away? And if we take just the COVID side of payments out at the state level, our net income would have went down from the 168,000 to about 92,000. If all government payments were removed, that would go down to about 55,000. The South Central and Southwest areas have the strongest net incomes with the government payments removed as we look around the state. And certainly the lowest income, as we take all government payments away in Northwest Kansas, they would have had about a 42,000 loss for the year. So much variation in what those things look like, and some of the items such as yield levels and impact of livestock certainly come into that. The last several years, we've definitely seen an increase in ad hoc support coming to agriculture. And so we'll kind of transition here and look at what has some of that ad hoc government support coming into agriculture. What has that looked like across the last 3 years?
We're going to take a look at a histogram showing the distribution of farms based on the percentage of our government payments, based on government payments as a percentage of value of farm production, which is the measure of that we use for essentially for gross income. The increase in ad hoc payments, whether that's a result of loss of markets or commodity prices due to trade conflicts or pandemics, the payments in these 3 years led to government payments as a percentage of income of value farm production that were 2 to 3 times the recent decade. Most of the farms in the far left of this, in the bars to the left of this histogram, are farms with zero government payments, and there was quite a reduction in the number of farms with no government payments in 19 compared to 18, and then again in 20 compared to 19. As we move to the right of the histogram, move across the axis, you can see an increased percent of income coming from government sources. We're going to take a look at a 50-year history of net farm income for the across the state for the associations, and I'll point out that these values, these net farm income values, are adjusted for inflation to 2020 dollars. So just taking a look at each of the decades, each of the last 5 decades, the 70s, in 2020 dollars, the average net farm income was about almost 95,000. Now you can see 1973 really brings that average up. 1973 average was 248,000 in 2020 dollars. If we take that year out, the average for that decade drops to just under 78,000. Then a significant drop to about 34,000 average for the 1980s, up to about 59,000 in the 90s, 79,000 in the 2000s, and then about a $106,000 average from 2010 to 2020 or 2019. Besides 1973, 2020 is the highest year, again, inflation adjusted. 2010 is very close to that at $165,000. On the low end of that was 2015, about $6,800, $6,900 positive, and 1981 was a loss of about $3,700. Let's bring in government payments. Again, government payments are adjusted for inflation to 2020 dollars. It's pretty clear here that 2020 was the highest level of government payments. Right behind that was 2019. Inflation adjusted amounts for 2019 at about $80,000, 55,000 or so in 2018. Prior to that, looks like 1999 was the highest year prior at about 73,000. Now, if we've added in the average for each of those decades with and without government payments. So in the 70s, without government payments, about $85,000, again, adjusted for inflation in 2020 dollars. In the 80s, net farm income without government payments at about $8,600 average for the entire decade. Excuse me. In the 90s, big jump to 27,000, another jump to 42 or so in the 2000s, and then 73,000 for 2010s. I'm not sure exactly what this says, but we found it interesting that the average farm in 2020, the net earnings without government payments for the average farm was about 55,000. That was 64% of the earnings of the entire 1980s decade when we factor out government payments. So it goes without saying that the 80s were a rough decade. As you can see, the influence of government payments increases from each decade. About a $10,000 impact on average in the 70s. About $25,000 impact on average for the entire decade of the 80s. 32,000 difference between net farm income with and without government payments in the 90s. And then about 37,000 in the 2000s. This did drop back slightly in the 2010s to about $33,000 difference between net farm income with and without government payments. And that the 2010s influenced by 2018 and 2019 very significantly. I think it's probably important to note that in 2020 at 113,000, it's unlikely that level of support will continue. So we'll see what happens over the next decade.
And certainly here, as we move to a chart looking at the liquidity trends across this close to 50 years of history, again, beginning here in 1973, as some of our debt level information isn't as clean in the database prior to that time. So not quite as many years, but all of these things where a year ago we mentioned kind of wondering where things were going to be financially to a potential negative side to this point in time where the year turned out much better than that. And the position for the average KFMA farm and certainly the current financial position very strong as we end in 2020. This chart shows working capital, which is current assets minus current liabilities for the year. Those gray bars going across showing that. The line across the chart goes over to the right side axis, and that does represent a working capital ratio. The ratio that we're choosing to use here to represent this to you is working capital as related to operating expense plus interest. So we're assessing working capital relative to what that farm is needing those dollars to cover as they look at their operating expenses across the year. Having a high level of working capital certainly puts a manager of a farm in a stronger position, a strong position of control relative to decision making on the farm. When working capital is tight, that manager will find others around them maybe influencing some of their decision making ability. As working capital becomes strong, that ability to be in control of decision making is increased for those managers of the operations. And our working capital level at 443,586 as we ended 2020, certainly the highest level. And again, these are all inflation adjusted dollars across this chart. So the highest level that we've seen in the history of this database. That number certainly varies from farm to farm as we look at the different groups. Our high income, our low income group, considering the working capital ratio, that's about 85% for the average farm in 2020. For our top quartile of net income farms, it was about 102% as we ended 2020, and for the bottom quartile at 28%. So as I referenced the role that has on the ability for those producers to feel in control of their decision-making on the farm, a wide difference depending on that financial position that a farm finds themselves at. And certainly then a question we would ask each of you, what is your working capital position? Do you know or understand what that is? Are you in a strong working capital position or a weak working capital position? And how are you going to respond in the midst of that situation? I think much reason to consider if you're in a position of weaker working capital to be working together with those advisors and others around you to see if there are steps you can take to improve that situation. If you're in a strong working capital position, I think there's reason to Mark mentioned just here as we ended the last slide that it's unlikely we can expect the same level of government dollars coming into agriculture. Gregg, a little later here, is going to reference some expectations for income just relative to expected yields, expected prices, expected expenses in 2021 and 22. But I think it's very important to make sure that as a manager of an operation, you look to use the current circumstances to prepare for the future, to position yourselves to meet the goals and objectives that you have. And in order to do that, you're going to have to understand your position, understand your resources, and carefully consider the best steps to take as you move forward. So we continue to look at our overall financial position of the farms. We'll move into looking at a solvency position, or considering here the debt level and the debt to asset on the farms. So our gray bars now going across our inflation adjusted levels of debt in each of these years from 1973 to 2020. The line going across represents our debt to asset level. Total debt per farm was, and we mentioned this earlier, but it was down slightly in 2020. The nominal dollars, it was down about 23,000 or just over a 3% reduction in debt per farm. That decrease was made up of a 34,000 decrease in current liabilities and a little over 11,000 increase in non-current liabilities. So some movement of dollars to the longer term, which certainly could be influenced by the fact that we saw that increased machinery investment, making some of that debt showing up as intermediate liabilities as we consider the dollars here. The last several years do represent the highest level of debt that we've seen per farm. But while these are the highest levels of debt we've seen, you notice as you look at the line going across, our debt to asset level is actually at some of the lowest levels that we've seen in this 50-year history. It's been 20 to 25% most of the last decade. The 90s and 2000s kind of in that 30 to 35% level. Much of the 80s 35 to 40% or greater. 85 showing here at 42%. And keep in mind as we look at these, this is an average of a group of farms. So within there's farms in a stronger financial position, farms with a higher levels of debt or a higher debt to asset ratio. As we also consider these levels of debt, I think it's worthy to consider the impact of interest rates. And all of us are aware, I think, that we're currently at a very low interest rate environment. And many things around us would indicate that these levels of interest are expected to stay low. But as we look at some of the inflation that's maybe being seen in different places, you might wonder, can our interest rates continue at this level? We do not have in the KFMA database the actual interest rates that all of the members are paying on all of their loans. So the best way we can represent interest rates in this data set is to look at what I'm going to call here just the effective interest rate. To arrive at that, we're dividing the accrual interest paid by the farms in a given year. So cash interest with an adjustment for the change in accrued interest on the beginning and ending balance sheets to arrive at an accrual interest amount paid for the year. And then dividing that by the average debt. So the average of the total debt on the beginning balance sheet to ending balance sheet for that group of farms for the year. This rate peaked about 12% or so back in the early to mid 1980s, reached a low of about 3.75% in 2014, 2015, and it's come up some from then to about 4.5% the last 3 years. If that effective interest rate were to go up, say a percent, what impact would that have on our KFMA member farms? And at this point in time, that would result in more than a $7,000 increase in the interest expense per farm.
So after looking back a little bit at 2020, we want to take some time to look ahead, and Gregg Ibendahl will spend some more time looking ahead once we're done. But what do we see around the state? We do have we've had some moisture recently, but there are still areas of the state that are dry. If you follow the drought monitor, that's been a pretty radical change in the last month or so. And with that moisture, there's some potential for good crop yields in certain areas. I think what we can expect to see is continued price volatility, and I don't know if that's the new normal, or if it's just a short-term trend. But what we've seen in the last 12 months tells us volatility is an issue, and that leads to questions about marketing and making sure that you have a good plan in place and you're ready to take advantage of positive changes in prices. With run-ups in prices at the end of 2021, I think we can expect that input costs for 2021 and into 22 will be significantly higher. Fuel prices, energy costs have gone up. Suppliers, I think will use this increase in prices in late 2020. In some cases, take advantage of those higher prices, whether that's for different crop inputs. We're going to see some continued legislation that's going to impact government payments. We've already, I think most have received their CFAP 3, the Coronavirus Food Assistance Program, the third round of payments. The PPP loans in 21 are going to have an impact, as we talked about before. As we've mentioned, what should we expect going forward when it comes to government support. Outside of the farm economy, several other things will have an impact in the future looking forward. What are we going to see with estate taxes? Several proposals lately to change exemption levels or stepped up basis versus carryover basis that might have an impact on ag producers. And what will we see with carbon credits and in conservation programs? There's a lot of uncertainty when it comes to those areas.
So as we look to wrap things up here, certainly question we might ask is, or you might ask, what can you do? What do you do in the midst of this circumstance and these this volatility, the uncertainties in which we face? And, well, our work as the KFMA program is certainly to help farms keep good records and use those records. So it seems that would be one of the points we would give, but I think it can't be overstated. The importance for each of you as a manager of a business to have a good set of records and to be using those records to make your management decisions. We can give you averages, we can say what a given group of farms looks like, but the variation we see in those numbers tells me that if you're making decisions based on our averages or a given group of farms, you may not be using the right information for those decisions. So know your numbers, use your numbers, have those together on your farm. And it's with those records, you're going to be able to know your cost of production. I think the critical nature of that is the ability, by knowing your cost of production, to have that as the basis for your marketing decisions as you do planning, to know and understand where you're at for those commodities that you're producing. And certainly these current opportunities with our higher grain prices to take opportunity to price portions of your crop at levels that are above cost of production for your operation. Mentioned this earlier when we were looking at the working capital information, but seek to take steps to have your operation in a strong working capital position. That ability of being more in control of your decision making is extremely valuable to someone who's seeking to manage a business. And within that, we mentioned the increased machinery investment, and certainly investment in machinery and equipment is a very important part of managing a farm and getting the right equipment in place for your farm. And in no way, when we say manage this closely, are we indicating not to be upgrading machinery and equipment and moving forward relative to that. But our encouragement to you would be to look at using a planned approach to machinery and equipment purchases. List the items that are needing updated on your farm, prioritize them, and take steps according to that priority of needs to receive the best impact back to adding efficiency to your operation, adding ability to farm in the way that you want to farm as the manager of that operation. And in the end, all of this coming together to our encouragement to you to think strategically, think proactively as you manage in the coming year. And that will allow you to be positioned and ready to respond as all of these various unknowns come and approach each one of us. So with that, I think we're concluded. Maybe a very quick answer we can give here. I see one question there in the chat regarding a retired landowner, cash rent, crop share. I think the answer to that is very tied to that individual and the amount of risk they're interested in taking on or willing to look at. Certainly in most cases, crop share is going to have opportunity for at least the potential there for a higher net return as you can take advantage of some of the higher prices, higher yields. At the same time, there's risk of a potential lower return. The cash rent being more stable across time, but generally maybe at a lower level than what the crop share might be. So I think looking at this time of volatility and unknown that we're in, Someone who's more of a risk taker, someone who really likes having crops to sell, is going to lean the direction of crop share. Generally, those moving into the retirement stage are not wanting so much potential variability or unknowns, and would make them more comfortable with cash rent. So, anything you'd add to that, Mark?
Nope, I think you covered it.
All right. Well, we appreciate all of you taking the time to listen, whether it's here today or listening to the recording of this. And I think it's time for us to give Gregg the floor so he can tell us what's really going to happen next year.
I just thought I'd give you a brief overview for 2021 and 22. Again, I'm kind of going out on a limb here for some of this part, but I can't be any worse than what I did last year, because last year I thought we were going to have a break even year at best, and it turns out we have one of our best years ever. So I guess I'm kind of like the weatherman in that regard here. So with that regard, keep that in mind that last year wasn't a very good thing, but I am going to go ahead and base a forecast with a lot of assumptions. The biggest one is I am assuming that we're going to have normal yields, and that's really a pretty big if at this point in time when the crop is now starting to get in the ground. But producers are out there making loans and that kind of thing with the idea they're going to have normal yields too here. So I don't think that's too much of a stretch to assume that there'll be an average yield as far as weather is concerned. Although again, certain farms will fare better than others in regard that is the way that goes as well. And again, as Kevin mentioned, not every farm is going to enjoy what the average is seeing. There's certainly going to be pockets out there where we're going to have droughts and other problems. So we need to be aware of that not every producer is going to get the same income we're predicting as far as what the average is. And again, my prediction is going to be based on the grain farms only. They have 3 years worth of data, so it's going to be a little different numbers than what you saw Kevin produce. In fact, it's going to be a little different than even the grain farms we have in our KFMA summary, because I'm including both irrigated and non-irrigated farms together in my predictions for this. Again, I'm looking at yields and prices, crop acres, expenses, crop insurance, and then the farm bill payments. And I'm basing my information, I'm using 2020 as my baseline for the KFMA farms as my projections for 21, 22. Well, how did I do last year? Or basically what did I do from my estimate I made back in January, which was based on the older KFMA data, what I was predicting for 2020. Well, I was actually predicting that time a net farm income of $137,000. Turns out I was low quite a bit by about $50,000. But a big part of my missing in that estimate was the fact that I had corn revenue way lower than what it turned out to be. So my model for taking the state grain prices and coming up with a farm price a little off, I think that's a good indication that our KFMA economists have done a good job of getting a better price than maybe what the state average is for the year here. So again, that's where most of it comes from. I was a little lower on government payments, which made my total gross revenue number a little low too. On the expense side, I was again a little bit lower on most of my expense estimates, except for fuel, where it's about $3,000 higher. It turns out when you add all this together, then my total farm expenses were about $20,000 lower. Combine that with the $20,000 lower in gross revenue, it means my net farm income was about $50,000 too low. Doesn't mean even though I was off there, I'm still going to go ahead and make a prediction for this coming year here. So here's what I'm predicting for 2021, again, assuming kind of normal yields and such. And it looks to me like 2021 will turn out to be a great year for the average producer. Again, assuming we get good yields or average trend line yields. And again, this is the average for all producers in our KFMA program that are grain farms. This $231,000 would be about a 25% increase over this current year, again, which was a very good year. Something to keep in mind, though, going into 2022, though, the following year, this is really getting out on our limb here because I'm not even sure what the planning intentions are going to be, but it looked like maybe a potentially big drop off in net farm income based on what the futures market is telling us about future grain price and the fact that we may not have any government payments at all for 2022 here. That would take us down about 54% over what I'm predicting in 2021. Still a pretty good net farm income, but certainly a lot lower than what I'm predicting for 2021. Here's kind of again, I'll have this in Ag Manager article so you can see specifically where I'm talking about where these changes are going to show up here. But you can see on the revenue side, again, most of our extra revenue is going to come from higher grain prices and such, which leads to quite a bit more money. Now that CFAP 3 that I think most producers have already gotten, that turns out to be about $44,000. So that's a good chunk of our net farm income right there. is showing up in that particular payment. And that means our value farm production, which is another measure of gross revenue, that puts us close to $1 million as far as average gross revenue is concerned. Again, that's going to drop off quite a bit in 2022 thanks to lower grain prices and not anything on the horizon as far as what government payments could be. On the expense side, again, as Mark and Kevin mentioned, some significant increases in expenses for this current year. I think all those higher expenses will carry on over into the following year, and I'll talk about those in a little bit more detail as I go forward here. But again, looking at a couple of years of some really higher expenses, and I'm not sure how many of those will ever go back down. Certainly, I think fertilizer and fuel tends to go back up and down based on what the raw material price is, but there's some things like seed and especially machinery, I don't think tends to go back down. Once it gets ratcheted up to a higher level, I think it tends to stay that way. So something to keep in mind going forward on the expense side. Here's what our range of net farm income looks like, looking at different percentiles. So again, the 25th percentile would be, we would have 25% of our farms that would earn higher than this top number. We had the median value, which is basically the 50th percentile. And then you can see our average value. So our average value typically tends to be higher than what the median is because we have several of the real bigger farms tend to bring up the overall average, whereas the typical producer isn't quite earning quite that much. And then we see our bottom 25 percentile. So based on what it looks like for this next year, even our bottom 25% of our farms ought to be doing pretty good. Where typically we'll tend to see maybe at least some of those, maybe not even earning a positive profit. And then here you can see my distribution of net farm income. So the way to read the CDF graph is this is basically the percent of farms who would earn that income or lower. So at the 50 percentile, which is our median value, you can see what we're projecting for 2021. We're here about the $167,000 value, and half our farms will earn lower than that. So this tail is always the thing I always kind of look at when we're looking at net farm income. You can see for this last year and this current year coming up here that we're in, that about 10% of our farms will still be losing money. And that's going to jump up in 2022 with lower grain prices, probably to the 25 to 30 percentile, or 30% of folks will probably be earning negative net farm income in 2022. So here's what's happening in my model for prediction for this year based on the intended planning that came out earlier this spring. We saw a big jump up in sorghum acreage potentially. I won't know for sure for that until later this summer, till I get some hard numbers about how many acres actually went in the ground. But earlier in the spring, there was an intention of 20% more sorghum acres, 11% more wheat. Those sorghum acres came at the expense of corn a little bit. We lost 5% of our corn acres and 1% of our soybean acres. Again, this was based on what was provided back in March. So again, where those actually acres turn out to be that were or not, we'll wait and see later on here. But that's the acreage shift. Again, much higher grain prices if you all have seen so far, but again, much higher expense as well here. What I'm projecting is probably a 30% increase in fuel and fertilizer for this year. And then again, with an extra 10% in 2022, that may shift around a little bit, maybe not quite so much in 2021 and maybe more in 2022, but certainly big increases in those two categories of expenses, which are some of our major expense category. On the seed side, I'm going with the idea that most producers probably locked in their seed before we see a lot of these increases happening in grain prices. So I only have a 5% increase in seed budgeted in right now, but I think 2022, you're going to see significant increases in the seed price, especially for things like corn. Again, I think most of those will show up in 2022. Most of the other expenses I'm thinking are probably going to be at least 5% or so. Depreciation, though, may be one of those exceptions because, as Kevin mentioned, a lot of producers took their extra windfall in higher profits this last year and put that into machinery, which is a typical machinery buying strategy for most producers. So just by buying more machinery, at least going to lead to higher depreciation, even if equipment prices stay the same. The fact that you're buying more of it is going to lead to higher depreciation amounts. And as far as government payments are concerned, again, we're expecting an ad hoc payment of $20 per acre. By far and away, the best source I think in the country is really Robin Reed. I've heard people on Facebook, this grain market discussion book I follow pretty closely. They compliment about Kansas State's information, quite extensively on that we do such a good job of providing government payment information. I think we have Robin to thank for that. this last thing that she presented, this webinar, is a good source for this, really this third round of CPAP payments. I would encourage you all to look at that if you already haven't. Well, what's happening on the machinery side? Well, Deere's already announced that their sales for the second quarter in 2021 are up 30% to 35%. So that's a big change already in the equipment numbers. On this grain market discussion group, I've also heard some discussions that, and they were kind of saying this in a joking manner, this is back in March, saying that we better buy machinery now because equipment dealers are going to run out before the end of the year. So farmers are already thinking about taking their extra profits for this coming year and putting that into machinery here. And certainly Deere is going to be the beneficiary of that. On the fertilizer side, so here's a prediction I made back at the end of January, where the purple is the actual anhydrous ammonia price for the country, the average price. The green is what I was predicting. You know, last summer we were basically at a point where anhydrous was about $400 a ton. I was predicting that we would probably get to about $600 by mid-year. Again, I thought that might be on the low side, but my model was saying it was going to be about 600. We're already about 700, 710 on the national price. So even this is a little bit low, but corn prices turned out to be a lot higher than what I had first predicted as well here too. So if you look at my model, which I think I updated back in February, this is my model for predicting fertilizer prices. I would encourage you all to go back and look at the Ag Manager article for that. But my model, if you plug in 650 corn, again, this is the national price, $70 oil, that would say that we're somewhere in the 700 to 750 price, probably between now and probably next spring. Those prices holding kind of steady here. So again, I don't really expect fertilizer prices to decline a whole lot unless corn prices tend to go down quite a bit. But I think we're looking at probably $700 anhydrous probably for the next 9 months or so going forward here. So I think if you haven't bought your fertilizer already, I don't think it's going to have any really good buying opportunities before next spring. That's going to be much cheaper. What about diesel? Again, that's another major input to most farmers. So, you know, last year with the pandemic, the diesel prices went down quite a bit. We were this is the highway price too, by the way, not the farm price. So nationally, we were about a $2.50 per gallon highway price. Because obviously people weren't doing a whole lot, but since then prices have really jumped up. Now we're kind of following what happened in 2018. So we're almost 80 cents higher than what we were a year ago, which is about a 40% increase in diesel prices over 1 year here. That's going to, if you haven't already seen that in your fuel bill for producers, it's going to show up pretty soon. I think that's a bad omen for 2022 because I don't think you're going to avoid paying a much higher diesel prices for next year's production cost. Here's what I worry about in as far as going forward for our producers. What's going to happen to expenses if grain prices go back down? And I think based on what the futures market is telling us, that's what they're expecting for 2022 for sure. Well, I think some of these will go down, some of these won't go down. Like I mentioned earlier, I think things like fuel and fertilizer tend to follow what's been happening with some other things that go into those inputs. So if the fuel and corn price go down, I think you're going to see a lower fertilizer price, but other things I don't think go down quite as much. So seed may be one of those categories. It tends to ratchet up and maybe not ratchet down so much, but machinery I think would be the biggest category there where it ratchets up, and I'm not sure if it ever ratchets down. The other thing I worry about is inflation. I adjusted a lot of my expense categories to be a 5% minimum. I think we may be entering a new inflation era, which kind of worries me. Those of us old enough who can remember the early 80s can remember what the effective inflations were during that time frame. And I don't think it was a good thing. I think that was one of the contributing factors that may have led to the first farm crisis back in the 80s here. So something to be worried about, but at least the older folks have some experience with that. The generations that don't, though, the millennial generations, these generations, they don't really know what inflation is. They never had to live back to the 80s and don't really, may not know how to handle a situation like that. So this may be new territory for our younger farmers out there. And I also worry about family living here. So as Kevin mentioned, you know, family living's in the $70,000 range or so when you look at that in real dollar terms. And this is a graph I just published here a couple of days ago on Ag Manager about the different inflation or different categories of family living adjusted to real dollar values here. So you can see the first thing that should stick out to you is that health insurance have climbed quite a bit, the purple line. But here's the red line, what used to be the #1 category, entertainment and recreation. Well, that expense category dropped off tremendously last year by about $2,000, mainly because no one went any place last year because, you know, with COVID restrictions and such. My big worry this coming year is if farm producers are looking with a really good net farm income in 2020 and really even higher than that in 2021, what's going to happen to entertainment and recreation dollars here if you suddenly see a lot of dollars in the bank? Is this number going to jump back up? The thing I've noticed about entertainment and recreation is it's pretty easy to ratchet this number up. It's a lot harder to pull this number back down once you get used to living to a certain category like that. So that's something I worry about, that we may see a big jump in here. I hope that's not the case, because certainly what we're seeing for the projection for 2022 is that we're going to see net farm income fall back off again here. So again, just watch your family living dollars, even though you may have a lot of dollars, set some aside for a rainy day. So again, that's my prediction for 21, 22. Don't hold me to this because it could very easily change, and it did last year, but I'm going out on a limb and kind of saying this is what's going to happen for the coming years. So I guess I can take some question now at this point too.